Hey guys, and welcome to the channel. Today we're going to be breaking down two of the most popular monthly paid income ETFs available to UK investors. Now, that is JEPI and JEPQ. Both launched in 2024, both pay monthly dividends, and both use covered call strategy to turn the market volatility into cash flow. And if you're wondering if they should be in your portfolio or if they're even one of the best UK monthly dividend payers, then this video is for you. But remember, before I go into any more detail, this is not financial advice. Please do your own research, and this is just entertainment and purposes only. But basically, these two stock ETFs are not identical. One is built for the S&P 500, the other one is the Nasdaq 100. One is more stable, one is more volatile. And depending on what kind of investor you are, each plays a very different role in a long-term portfolio. And first up is JEPI. So it's the JPMorgan Equity Premium Income UCITS ETF. It's a long name, but that's why everyone knows it as JEPI. Now, at the time of recording, it does trade around 24.350. Now, that is with a 398 million assets under management and a 9% dividend yield. Now, its object is simple: provide income and long-term capital growth. Now, JEPI is built on the S&P 500, meaning it holds large cap US companies across every major sector. You got the tech, you got the healthcare, finance, consumers, and industrials. Now, this ETF is designed to be a steady engine of your income strategy. It's broad, diverse, and intentionally low volatility. Now, a JEPI job is to pay you consistently, but not chase the big market upside. So, for example, if the market goes up, then JEPI will go up slightly, but not as much as the market will. And we get on to JEPQ. It's the Nasdaq Equity Premium Income UCITS ETF. Now, JEPQ, around this video, trades around $27.77. Now, with much larger assets to management of 3.27 billion and a higher dividend yield at 10.21%. And just like JEPI, it has two goals: income plus long-term capital growth. But the key difference, because there is a big key difference in this one, JEPQ is built on Nasdaq 100, not the S&P 500, the Nasdaq. And if you don't know what the Nasdaq is, it's basically like the technology fund. So like the S&P 500, where it holds 500 stocks in the US, Nasdaq holds one of the top 100 technology stocks. So that means you've got like Nvidia, Apple, Microsoft, Amazon, Meta, ADM, Tesla, and other high volatility innovators. And that is why JEPQ is a little bit different, because that is what it's concentrated on. See, now this ETF is designed for investors who want more higher income, more upside, but also more movement. It's still an income ETF, but it behaves much closer to a growth tilted product. And what do both ETFs actually do? Well, the thing is, JEPI and JEPQ make money in two different ways. Now, one is stock exposure, so they hold large cap US companies. The names you find will still find in the S&P 500 or the Nasdaq 100 version. They cover call premiums, so this is where the magic happens. The ETFs sell options on stocks they hold. When volatility rises, option premium rise. And that's the premium that's paid out to you as a monthly income. So like I say, JEPI is for the S&P 500 version, and JEPQ Nasdaq is a 100 version. So both use their options there. So both do sacrifice some upside in exchange for the steady monthly cash flow. So you're trading explosive growth for predictable income. So for example, I think when Amazon or like for example Nvidia went up 100%, JEPQ will probably only go up by like 20%. So you are missing out on that upside, but you're getting that for the steady monthly income. So how do they do that? So let's dive deeper into what covered call premiums are. So this is what happens. So when the markets are volatile, the option premiums spike because more volatility equals bigger premiums and bigger monthly payouts. And that is why JEPQ pays more, because tech stocks are naturally more volatile. But they also do get dividends from stocks they hold. JEPI holds more dividend-paying companies, like healthcare, financial, consumer staples, that do have good dividends. Where, JEPQ holds more tech, which pays lower natural dividends. So JEPI kind of relies on more of the traditional dividends, where JEPQ relies on more of the heavy option income. But what is the catch? Well, covered call ETFs are brilliant income tools, but they come with trade-offs. Your upside is capped, as mentioned before. If the market pumps, JEPQ and JEPI won't rise as fast as the index. You're giving up that growth in exchange for your monthly income, which, as you all know, that's sometimes good for a good psycho effect. The income is not guaranteed though, because premiums depend on volatility, and low volatility equals lower monthly payouts. And these are not growth ETFs as such. They are income ETFs with some growth exposure. So if you want maximum long-term upside, you use a traditional index fund instead. So what do JEPI hold? Well, JEPI holds roughly around 242 stocks. Now, it's not the complete S&P 500, but with the 10 making up the 20.22% of the fund. Now, this is extremely diversified, intentionally so, because the breakdown is 93% US and 6% Europe. JEPI blends more the mega cap tech like the Apple, Microsoft, Amazon, and Nvidia, with more defensive names in healthcare, finance, and community sectors. Because JEPI income comes mainly from covered calls, each position is kept small. The ETF doesn't really rely on the big stock moves, it relies on option premiums. This is what makes JEPI smoother, steadier, and more predictable. And of course, we have JEPQ's top holders. Now, as you can see, it is quite the opposite in structure. Breakdown is 96% US, 3% Europe, and 0.4% Latin American. Now, the top 10 stocks make up nearly 50% of the fund, which is far more concentrated. And as you can see, Nvidia, Apple, Google, Micron, Microsoft, Amazon are all pretty much up there, all above 4% of the fund. Now, this is because JEPQ leans more into higher volatility techs. Now, to maximize premium income, they do so by leaning into them stocks. Because tech stocks swing harder, option premiums are bigger and monthly payouts are higher. This concentration also means JEPQ moves more sharply, both up and down. So let's compare them both side by side. So JEPQ and JEPI. So JEPI, like I say, holds 242 stocks. Top 10 weight is 20%. It's broad, it's diversified, it's low volatility. Now, the most region that it's covered is 93 US. Income source is covered calls on the S&P 500 stocks, but they also have dividends from their stocks as well. And behavior is smooth, stable income first. Now, JEPQ is more concentrated, as we say, in the tech. So it's only got 95 holders. The top 10 weights over 50%, and the style is tech heavy, high volatility. Now, like I say, the top names are Nvidia, Apple, Alphabet, Micron, so on. Now, instead of 93% US, it's actually 96% US here, with the income source mainly on covered calls on the Nasdaq Tech, which means higher income, more upside, more swings. So JEPI is more like your calm, steady wave, steady income engine. JEPQ is more your little surfboard guy, getting higher yield, higher movement with each wave of the tech. So what really is my final verdict? Well, JEPI and JEPQ both earn a place in a long-term portfolio, in my opinion, because they turn the market volatility into monthly income without you needing to trade the options yourself. Now, they're simple, rule-based, diversified income engines that quietly compound in the background. As mentioned, JEPI gives you the steady, low volatility income from the S&P 500, while the JEPQ gives you the higher yield and tech exposure. Together, they can really form a small but powerful slice of a long-term plan, especially if you drip feed into them consistently, which I'm definitely going to start doing. And if you wanted me to dive a little bit more on why I'm doing this, then of course, comment down below, leave a like, hit the subscribe button, and we'll do more on JEPI and JEPQ. But the reason why I'm doing it is because I'm not really chasing big returns. I'm building a reliable, compounding payout portfolio that works quietly in the background. And together, at the minute, they control about 2% of a slice of my portfolio, so it's not much. But in the longer term, I'm aiming it to be around 10 to 15% to hopefully give me some more income. But hope you guys enjoy, and I'll see you on the next one. Goodbye.